All right, greetings, fans of advanced accounting, and that's what you are. We're going to walk through the comprehensive problem, which is going to lead into sort of a homework assignment as mentioned in the email. But having us do this through the comprehensive problem, which is in your textbook, so this will be a great way for you to continue to study and review things since it's going to all be there. I won't go through the details of what's in the problem. I'll just point out the important parts. You can read the details on an as-necessary basis. We've got a purchase, father company, obviously the parent, buying for $425, 80%. That sets us up. Notice the cleverness of this textbook continues to amaze us when it shows you the name of the subsidiary as son as opposed to father and son. Isn't that wow? You got to get blown away by that kind of information. Okay, so back to important things. So 425 is what they pay for 80%. Then the problem tells us that the non-controlling interest, the remaining parts, are valued at 1025. So we can now figure out what the real value of the company is supposed to be and then compare it to what father paid. Well, let's take a look. 1025 is the fair value, not accounting for any control premium. It's the fair value because that's the non-controlling interest, which would not have any control premium attached to it. Non-controlling interest will be based on the real fair market value at all times. There's no control premium added to it because it's not being bought. Control premium is only by the purchaser, in this case, father company. So 1025, do the old trick that we've learned since the beginning of the course, divided by 0.2 is going to give us a fair value of the company to be 512, 500. That's for 100% of the company, not including any control premium. There may be goodwill in there, that's possible, but we'll soon find out. So that's really where we're at now. Well, what we have to do is figure out from the information given to us. I'm going to clear the board. From the information given to us in the problem, we now have to figure out where we're holding in terms of what was paid at the date of acquisition, how much is the non-controlling interest worth, and break it down between the two parts so that we can figure out who has the goodwill, whether it's control premium goodwill or something or a combination. So let's do that, and then we'll come back to this slide. Here we go, acquisition date schedule right here. And they're going to use the acquisition date fair value of not 512, 500, but 527, 500. What's the difference? Good question. Okay, so let's figure out how do we get there and why do we get there. Very simple. Paid 425, value of the non-controlling interest is 1025. So put it together. 425, 1025 equals 527, 500. So that's the value based on the purchased and the non-controlling interest amount. So you put those two together, 1 plus 1, and you're going to get this number here, 527, 500. Had it not been, now you already know from all this that you know that there is some control premium being paid, because at the number, the value, the implied value we got back here when we did the non-controlling interest part, 1025, at 20%, we came up with 512, 500, and yet 80% of that, 80% of that number is 410. So you can already see that there's been a control premium paid beyond the fair value of the company at 100% using the non-controlling interest as a way to gauge what the fair value is going to be. So indeed, we now know that if they paid 425, we already can see what the control premium was. And so that'll get illustrated here. Now what we're going to do is allocate the total value and we have to figure out what is the book value of the subsidiary. So we go back here, and we're told, now I'm going to erase the board now, we're going to be told that the book value at date of acquisition was 400. Here's the information. Date of acquisition. All right, so now we know we have to reconcile between the fair value for the whole company paid when you consider both halves, or both parts, the part paid by the father company buying the son company and the non-controlling interest part, and this is the excess value that we have to explain. So using the information in the textbook which shows the differences, that's going to be explained here. And all this does is get us to a point where we can explain everything except what we would anticipate, what we should have anticipated, is that we're going to be able to explain everything except for $15,000, which is the control premium. And that control premium will be allocated 100% as goodwill and 100% to the controlling interest side. This is going to be important later on with one of the adjusting entries on the consolidation, so just keep this in mind as we go forward, that 0 of the goodwill in this particular problem goes towards the non-controlling interest. Goodwill, it all goes to the controlling interest. All right, let's take a little bit of a clear the board a little bit and then see the rest of the schedule. And of course, the rest of the schedule here does the annual amortization. In this case, we've got all positive amortization, meaning we're adding, we're not subtracting. We don't have any negative amortization or negative depreciation. So it nets out to a total positive amortization each year. And since it's I don't know if I pointed it out clearly on the first page, but this is a 5-year problem. We start with 2011, and we're going to be doing consolidated at the end of 15. So we've got 5 years to deal with, and therefore we're going to have to account for 5 years of amortization, 4 years prior to the year we're doing, and the current year. All right. The amortization per year, we now know, is that number. So we've now examined and come up with a couple very interesting and important parts. We now know that the goodwill belongs to the non-controlling interest, $15,000, 0 to here. We now know what the annual amortization is. All this will become important going forward. The book does what I've explained you should do, and that is to set up an amortization schedule to show where you're holding. This one just sort of skips over the 4 years and goes right to your balance as of 1/1/15. This is a great way, by the way, to set yourself up. So this problem's already brought out some valuable information on how to approach these problems when they're particularly multiple years, because now what you got is you got what you need, and that is the beginning balance of all these different accounts. Look what this schedule has done. So I would encourage you to study it and figure out how to do this. It shows you the excess that we got from the problem before. It shows you what the amortization would be, and then it gives you the remaining balance at 1/1/15. This is going to come in handy when you go to do your A entry. Land, obviously there's 0 here, so land will be the same, and so on and so forth. So it gives you your, basically it's going to give you what's going to be your A entry. All right, really good schedule. If you're not sure of this schedule, that's a big problem with me. If you're not sure, I'll sit down and help you with it. But it basically relates to doing the math of all this for 4 years and ending up with the new adjusted basis or new book value. This is the book value at the beginning of the year. Okay, now what they're doing here is they're explaining something very interesting about this problem, which can be seen when studying the balance sheet at 12/31/15. So let's take a look and see what we're talking about. Interestingly enough, the purchase price was, the purchase price for this is, I'm trying to get a new color here. Here we go. The purchase price was $425 at the date of acquisition. And if you go down to 12/31 balance sheet on the books of the parent, ooh, same number. That tells you that this problem is that tells you we're no longer in Kansas. That's what it tells you. We're in the land of Oz. It also tells, because we haven't done problems like this yet, but I just described what we're going to do with a problem like this. First of all, what does this tell you? It tells you that the parent, father company, has been handling the investment in Son Company on the method of, yes, you guess, I heard you, you got it, initial value, not the equity method. So based on what I said in class, what we have to do now is we have to bring our balances into equity method. We have to adjust the books, even though we're not going to adjust the books inside father company. We're not going to do it. We're going to do it on the consolidated financial statement, but we have to do an entry. Part of our consolidation entries has to be to bring this investment account here into the line of what it would be if equity method had been done. So that's the next step of where the comprehensive problem goes. It explains how to do that, and we'll pick up on that next time. All right.